The CPI inflation report was released on October 13th. The rate of inflation was 8.2%. It's the lowest since February 2022. Here's the CPI inflation rate for the last few months. For the month of June, it was 9.1%, July 8.5%, August 8.3%, and September 8.2%. The September CPI rate is a major setback, and expect the Fed to be more aggressive. The Fed's target rate is 2%, which is very far from the current levels. Here's the monthly inflation rates for the past year. Look at October 2021. We were at 6.2%. We're facing high inflation for more than a year now. Here's the 10-year inflation rate. Look how much inflation has gone up in the past 12 to 18 months. Since the inflation is not coming down at the expected rate, the Fed will raise interest rates and ramp up quantitative tightening. This is bad for the stock market, the crypto market, and the housing market. The Fed will probably raise interest rates again by 75 points in the upcoming FOMC meeting, which is scheduled on November 1st and December 14th. The price of housing, food, electricity, and insurance continues to trouble American households. The average household is spending $460 more each month to buy the same basket of goods and services as last year. So ultimately, it's getting harder to pay for the basic necessities. That's a big burden, particularly on lower-income households. High prices for food, shelter, and medical care sent the Consumer Price Index for September up by 0.4% compared to August 0.1%, according to data from the Bureau of Labor Statistics released Thursday morning. As I said in one of my previous videos, the scary part is once inflation is above 5% in advanced economies, it usually takes on average 10 years to drop to 2%. However, the Fed cannot sustain high interest rates as banks and financial institutions parked $2.2 trillion. The U.S. yields crossed 4%. The rate of change is just staggering, leaving people and businesses no time to adjust. The U.S. government has $2.2 trillion in treasuries that will soon be refinanced to 4%, costing us hundreds of billions in interest per year. Reports show that over the past 6 months, 32% of Americans have been paying their bills late, and 60% of Americans are now living paycheck to paycheck. Last year, it was 55%, and 45% of people who are making over 6 figures are also living paycheck to paycheck. Also, 55% of workers say their pay isn't keeping up with inflation. Here's the price increases over last year. Fuel oil up 58%. Gas utilities up 33.1%. Gasoline up 18.2%. Electricity up 15.5%. Transportation up 14.6%. Food at home up 13%. New cars up 9.4%. Used cars up 7.2%. Shelter up 6.6%. We all know that 6.6% rate is government figure and that the actual number is a lot higher. Even if we go by the government figure, the number is still one of the largest since 1986. The higher prices are hitting consumers hard. The rising cost of food, in particular, has been difficult for many households. The price of chicken has risen 17.2% over the last year, while milk prices have increased by more than 15%. Meanwhile, energy prices have risen by nearly 20%. So here's what my prediction is for the next 6 to 9 months. Something will break, either the stock market or the debt market or something. And that's when the Fed will stop raising interest rates and stop quantitative tightening and start the money printers. They'll pivot because they'll have no other option. This will skyrocket the stock market, crypto market, but the trade will be that we'll have high inflation. I'll make a detailed video on the Fed pivot soon, so don't forget to subscribe. In the short term, the Federal Reserve will continue to raise interest rates and will continue to ramp up the quantitative tightening. If you're investing in the stock market right now, please do your own research and be cautious. The increase in the interest rates will make the 10-year yield even worse than the current levels. The current level is already at 4%, which is very high. Also, the Fed will raise the interest rates on December 14th as well. This should tell you how bad the situation we're in right now is. The housing market has seen the most immediate impact of the Fed's rate-raising scheme. At nearly 7%, mortgage rates are now at their highest levels in close to 2 decades, which has slowed home price growth in its tracks. and in some cities cause prices to fall. The Fed's interest rate target has risen by 2.25% in the last 4 months, the most forceful rate hike since the Great Inflation of the late 1970s and early 1980s. The target is now 3% to 3.25%, the highest it's been since the financial crisis in 2008. The negative Thursday reading means that the Fed will likely feel as though it needs to keep raising rates so aggressively, thus increasing the odds of a recession. Many economists predict that the economy will enter a recession in the coming months, given the pace at which interest rates have risen this year. By raising rates, the central bank hopes to slow economy-wide spending and inflation. When the economy slows too much, it can result in a recession and rising unemployment. Please subscribe. Thanks for watching. Until next time.